Hi, this is Jason from Lake Worth, Florida. Lately, I've heard a lot of advisors talk about taking profits and raising cash, but I've also heard others talk about putting cash to work by buying higher quality. What percentage of cash do you recommend in a portfolio?
Good question. Welcome back. With us tonight, advisors Josh Brown, Lazetta Braxton, and Dr. Carolyn McClanahan. Let's get right to that question. Josh Brown?
So my take on this is very simple. Professional investors enjoy a lot of advantages over individual investors, but this is one case where it's actually backward. The individual investor does not have to report quarterly performance to anyone. So the last thing they should be thinking about, the last thing when it comes to market volatility, is trying to shy away from that. Market volatility is the source of future returns. So Jason sounds like he's a relatively younger investor. I consider myself to be somewhat young. And so what I'm not doing is worried about how much cash I can have in a retirement account. My cash savings are elsewhere in the bank. So in an investment account, I'm trying to upgrade and buy quality stocks. I'm trying to make sure that I'm adding a consistent amount of money every month. And the good news is, with my own money, I only answer to myself, and I only answer to myself decades from now when I can actually use that money in retirement. Carolyn, how would you answer that question of Jason's?
Oh, so you're spot on. To me, cash is for savings accounts, and in your investment accounts, you should have an investment policy. Jason, being young, I bet he has the wherewithal that he could take a lot of risk, and so his stock allocation should be high. And right now, every bit of savings that he has should probably be going to his stock allocation. So people should not be sitting on cash in their investment account. When an older person has an investment account and they're using monthly withdrawals, that's about the only time you would have cash in there. You would have enough to meet the withdrawals that they have to take throughout the year.
Yeah, so I think what's important, Carolyn, is that using this term, they can take more risk. A lot of times people conflate volatility with risk, but when you're thinking about 20 and 30-year money, the real risk is running out much later when you can't earn more and replace it. The risk is not that you're going to buy a mutual fund and it's going to be down 10% a month later. Can you explain a little bit about why that's so important for people to set their mind on that concept?
Yeah, you're exactly right. So when you're invested in the market, the reason that you're invested in the market is because companies are out there doing all sorts of things to try to make money. Some are going to fail, some are going to do fantastic. And overall, through the years, companies tend to do well, and that's why stocks go up. So if you have a 20 to 30 year time frame, you can weather the bad times when the market goes bad. I mean, like right now, it's from coronavirus. And so it's not that the companies were doing poorly in and of themselves. And once we figure out how to get through this mess of a virus, then the economy can get back on track. So risk is all about how much you can afford to lose in any period of time, and young people have a long period of time, so they can take more risk, and ideally in the long run it's going to make a lot more money for them.